Good evening to all our partners. We are here once again for our weekly TradingLink trading sharing session. Today is December 6, 2024. It is the first trading week of December. At this very moment, it is time for the non-farm payroll data release. Overall, non-farm payroll data is driving an upward trend in the market. This wave of movement was something we had anticipated very clearly. Today's non-farm payroll data is, overall, slightly bearish. The number of jobs added is significant, but it falls short of expectations. However, looking at the overall market, the price action for gold remains relatively straightforward. First, let's look at the daily chart. Last week, gold underwent a 7-day period of sideways consolidation. The upper resistance was at the 4-day moving average of 2,685. This level has not been broken over the past few days. However, yesterday's price action indicated that today's non-farm data might give gold a chance to surge. Yesterday, after the US session opened, gold experienced some choppy downward movement. Towards the close, there was an upward spike, especially during today's Asian trading session, there was a rapid and dramatic movement. This occurred within the first 15 minutes after the Asian market opened. Looking at those 15 minutes, the total drop reached $20. Once this sharp move appeared, it became evident in most cases that today's trend would be bullish. From the perspective of market makers, yesterday's bearish downward move followed by today's sharp shakeout has cleared the stop losses for all long positions built over the past 7 to 8 days. Next, it's likely to see a breakout above the platform's upper boundary by the weekly close. This could lead to a breakout above the 2,690 level. If the full range is utilized, we could see a return of approximately 6 to 7 times leverage, equating to $60 to $70. Of course, the short-term intraday lower resistance level remains the intraday high of 2,667. After breaking the intraday high, it's possible to target the overnight high and even last week's high. Therefore, for this week's non-farm payroll trading, our strategy still focuses on a bullish approach. We also established long positions near the platform's lower boundary at 2,640 during the Asian session. Last week, the overall price movement was narrow, with limited trading opportunities. However, this wave might determine the overall profitability for the week. The key is whether gold will make an upward move after 11 p.m. today, breaking through 2,680 and reaching 2,690. If this pattern forms, the weekly profits should be quite favorable. Next, let's discuss the second asset. Crude oil's volatility remains, as always, underwhelming. Looking at last week's daily chart, there were 5 consecutive bearish candles. During Monday's US session, crude oil closed lower. However, after the market closed, around 5 a.m. Singapore time, the US announced that OPEC might delay its production cut plan to the first quarter of next year. In response, crude oil rebounded on Tuesday, forming a relatively strong bullish candle. It served as the starting point. However, market makers face significant challenges in controlling this price action. For example, after hitting resistance at this pressure line, all prices were pushed down further on Wednesday, even amid extremely bullish conditions. On Wednesday, U.S. inventory data reached a multi-month low, but prices still declined. Overall, trading yesterday remained challenging. Why? Because yesterday's OPEC meeting extended the production cut timeline from the expected 3 or 6 months to 15 months. This adjustment now extends to 2025 or even 2026. This should have been an extremely bullish development. However, prices still closed lower. Additionally, you can observe that there was a bearish liquidity grab during the upward movement yesterday. Under these circumstances, the daily chart continued to close bearish. Now, breaking the 3-month low of $66, as we mentioned earlier, seems imminent. Looking at the weekly chart, you can see that the pattern is highly unfavorable. This means that the bearish downside potential could soon open up significantly. Within the next 2 weeks, prices could drop into the $65–$60 range, establishing a consolidation zone. This is our overall trading strategy for crude oil. Finally, let's take a look at Bitcoin. Bitcoin was influenced by a new cryptocurrency official appointed by the Trump administration. Yesterday, it reached an all-time high of around $104,000. However, regardless of the market's reaction to this appointment or its expectations. It didn't hinder Bitcoin's upward momentum. We can observe some consolidation at the high levels. It is merely forming a breakout above the platform's upper boundary, followed by a shakeout and stop-loss clearance near the lower boundary. Yesterday, this particular candlestick first broke upwards and then reversed downward, liquidating nearly 200,000 contract traders. This is a classic example of what we often say about market makers manipulating the market, breaking the platform's upper boundary, then the lower boundary, executing a dual stop liquidation for both long and short positions. Currently, this does not affect Bitcoin's continued upward trend on the daily chart. After breaking above $105,000, it becomes very challenging to predict the next consolidation level. It is highly unpredictable and could potentially be above $120,000. Regarding non-USD currencies, we can see that after the dollar peaked a few days ago, it is still undergoing consolidation. Overall, trading activity this week remains relatively quiet. The volatility in gold remains limited. The expected large-scale fluctuations have not yet materialized. For instance, the fluctuations in the steel-related candlestick are also about $10 up and down. As everyone knows, during non-farm payroll events, it is normal for a single candlestick to move $20 to $30 multiple times in repetitive swings. Right now, gold is moving in such a pattern. In the short term, it may not necessarily exhibit extreme volatility. However, it could still affect an eventual upward close. Even on the daily chart, if it forms a bullish candlestick similar to last week, how should this be traded? If it forms a candlestick with no upper shadow after the close, it is recommended to close positions decisively at the close and rotate trades. For the next week, maintain a bearish strategy. Let's take a look at gold's Bollinger Bands. The 2,680 level on the 4-hour chart has been a resistance level during the high-level consolidation of the past 7 to 8 days. On the daily chart, the upper resistance at 2,720, the high from November 22nd Friday, will also be challenging to break. The 2,700 level could act as a short-term extreme volatility high. It is still considered a good point to short. The expectation is for the weekly chart to turn downward next week. Once the 2,613 level from this week is broken, bearish momentum might push it through to 2,570, referencing the November 22nd low of 2,669. This aligns with the weekly Bollinger Bands midline around 2,560, which corresponds to the recent 3-week low. Once short positions are established at 2,690 to 700, potential bearish returns next week could reach 12 to 14 times. If the entry size is 2% to 4% of the portfolio, the returns could reach an ideal range of 25% to 50%. This might happen in just a few days. So, what we need to do now is patiently wait for gold's upward movement. If the market does not rise and instead drops today, then our long positions established at 2,640 will be stopped out as cost positions. In that case, there might be no further trading opportunities for gold in the next 7 to 8 days. This is to ensure we don't lose money first. At an ideal price level, we will assess the fundamental news drivers, then decide on a counter trade strategy and monitor the platform's overall guidance. This primarily sums up the trading strategy for gold. We've discussed the patterns of several assets for this week and the next. Spot instruments may have some differences. When it comes to spot trading, you may not need to focus on breakouts around the platform's upper boundaries. Because there is no leverage involved, the scale and speed of losses will not be significant. Thus, it's fine to hold positions without concern. This concludes our overall analysis and summary. Thank you all for listening. We look forward to your continued attention to TradingLink's trader recruitment and development, and also to updates from our official channels. Alright, wishing everyone a pleasant weekend.